mind, looking for a dime. James Locke in the house, gonna help you shine.
All right, welcome everyone to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer two more Ask James questions of the day. First question, Don. He says, yeah, I read up on the Japanese recently. They're hiking their short-term interest rates. How is this affecting the market? Okay, Don, you wouldn't think that anything that happens in Japan will really affect the markets that much, but you have to realize it's a global economy now, and money flows from one country to the other. But first, why would Japan hike rates? Right? The rest of the world is lowering rates. Well, Japan's goal is to increase the value of the currency, their currency. And how does that work? Well, if you increase rates in your country, typically your currency gets stronger. If you decrease rates, your currency typically gets weaker. So, pretty much all the Western world is now decreasing interest rates to, say, stimulate, or is saying that the next move is going to be to decrease rates, as our own Federal Reserve is saying, right? So when Japan says they're going to raise short-term rates, as they did raise their short-term rates already, they announced they're going to keep a strong currency policy, which means they might raise them even more. And what are they playing for? Well, probably they're playing for the ability to import. If their currency is strong and ours is weak, they can now import lots of goods and services as they can do it inexpensively, right? So that would be one reason why they would want to do that, economic advantage. And there's others too, although, it doesn't help their exports, but it does help the imports, right? So what does that mean? That means, okay, if you're a Japanese investor in US stocks, all of a sudden, you want to sell US stocks, right? Because if you're in US stocks and our currency is going down and the yen is going up, when you try and sell those stocks, convert it back again, it's going to be worth a lot less. So if you're a Japanese investor, you want to sell and go to cash. You want to get out of the US. If you're, let's say, a European investor, and you're in US stocks, and well, now you might say, okay, we're going to liquidate some of these US stocks and maybe buy some Japanese stocks. Diversify. Why? Because again, if the Japanese currency is going up relative to Europe's, which, what's likely to happen in light of this news, I can at least make some currency gain by being in Japanese stocks. So Don, that's really it in a nutshell, why that move affected our stock market here. And it's kind of one of the many factors playing into kind of some of the volatility that we've seen recently. Now, for those approaching retirement, focusing on investing for income, this situation with Japan's interest rate, it presents some interesting considerations. It might seem distant from your immediate financial concerns. Those global economic shifts can in fact impact your income-generating investments. For instance, if you're holding international dividend-paying stocks or international bond funds, currency fluctuations can affect your returns. A stronger yen might boost the returns of Japanese dividend stocks when converted back to dollars, potentially making them more attractive for income investors. However, it's important to remember that chasing yields in foreign markets comes with additional risks, specifically currency risk, and potentially less familiar regulatory environments. So for most retirees focusing on income, a well-diversified portfolio with a significant portion in domestic investments is often the most prudent approach. That said, some exposure to international markets can provide diversification benefits. You might consider, say, international dividend-focused ETFs, that manage currency risk, allowing you to benefit from global dividend opportunities without directly dealing with currency conversions. Now, in light of these global interest rate movements, it's also worth revisiting a fixed income strategy. If you're holding bonds or bond funds, changes in interest rates can affect their values. A laddered bond strategy where you invest in bonds with staggered maturity dates can help manage interest rate risk while providing regular income. Now remember, while it's important to stay informed about global economic trends, your investment strategy should primarily be driven by your personal financial goals, risk tolerance, income needs in retirement. Always consult with an income specialist to ensure your income strategy remains appropriate given the changing global economic landscape. Great question to start off today. And if you want to have your question answered, if there's something on your mind, go ahead, email it in. poolelock@poolelock.com. All right, moving on. We're going to look at our second question, and this is from Ronald, from Ron. And this is a political question. It says, Kamala Harris hasn't really come out publicly with what her economic policy could look like. So how could that be affecting the markets? All right, Ronald, you're right. She hasn't said anything, which, quite frankly, that's a bit of the problem. President Biden talked about the desire to really hike corporate tax rates. And the fact that she has come out and said, I don't want to do that, has really concerned markets, thinking she might want to do that. Now, why is that such a big deal? So you might remember when President Trump took office, one of the first things he did was lower taxes. Corporate taxes, and he lowered the corporate taxes, and then the stock market took off. Why? Because if the corporations could lower their tax that they have to pay out, then their net earnings go up. If their net earnings go up, then the company's worth more. The stock is worth more. Well, clearly, the opposite would be true, right? If corporate taxes are hiked, that means the company's net earnings go down because they have to pay out more in taxes, which means the value of the company is worth less. So, that's a factor across the board, not to mention the fact that if you hike personal tax rates, that's going to hurt consumer spending, which has been fairly strong over the last few years. So it could hurt consumer spending, and all of a sudden, that's bad for demand for goods and services, and therefore demand for corporate profits. So it's not so much about what Kamala Harris has said or not. It's really, what she hasn't said yet that spooked the markets. And again, that's not a political statement on my behalf. That's simply economics, right? Lower corporate earnings means lower valuations. Higher corporate earnings, higher stock valuations. It's really one of a number of factors adding volatility to the market right now. And there's many of them, and any one separately probably, doesn't have that big of a factor, even two. But, when you put all these factors together, what happens is you get that 2,000 points off the Dow that we lost in the beginning of August, right? So it's never any one factor. But now, if you're approaching retirement, focusing on investing for income, this uncertainty around, political economic policies, it can create challenges, but also opportunities. It's crucial to remember that your investment strategy should be based on long-term goals rather than short-term market reactions to political speculation. So for income-focused investors, things like dividend-paying stocks, they can be an important part of your portfolio. Companies with a history of maintaining or increasing their dividends. Even in a challenging economic environment, that can provide a steady income stream. It's important, really, though, to make sure you diversify across different sectors to mitigate the risk of policy changes affecting specific industries. Now, in light of potential tax changes, it might be worth considering, tax advantage instruments, municipal bonds, right? They can provide tax-free income, which could become more valuable if personal tax rates increase. Roth IRA conversions, they might be worth considering if you believe tax rates may increase in the future. So real estate investment trusts, REITs, they can also be an attractive option for income investors. They're required to distribute a high percentage of their taxable income to shareholders, often resulting in higher yields. However, you have to keep in mind that changes in tax policy could affect REITs differently than other corporations. So it's also worth considering a balanced approach that includes both growth and income investments. So while dividend-paying stocks can provide current income, some growth stocks could potentially offer capital appreciation that can be converted to income in the future. Remember, diversification is what's key. By spreading your investments across various asset classes, sectors, you can help mitigate the impact of policy changes on any single area of the market. Lastly, it's important to stay informed, not to make a knee-jerk reaction to political speculation. Always consult with an income specialist to ensure your income strategies align with your retirement goals, risk tolerance, and to discuss how potential policy changes might affect your specific financial situation. Great questions again. As always, I love it. If you have a question, you want to send it in, you can email it to us, poollocke@poollocke.com. And if you like what you heard, go ahead and like and subscribe to the channel. I'm James Locke, your retirement income source. See you again soon.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.